JF Capital Advisors moderator. Let's start the recording, please. Okay, we're recording, we're live.
All right, so good afternoon, everybody. Appreciate you joining us for the second JF Capital Unplugged. For those of you that were with us last time, we're going to do things a little bit differently. So I think last time we answered about 15 or 16 questions. This time we're going to do about half of those. The idea being that we're going to spend a little bit more time on each, add some additional explanation and some additional depth. So with that, let's go ahead and jump right in.
Wait a second,
my name
Nick.
is
Yeah,
Nick
who
Mellis.
are you?
I'm going right in.
Okay,
Cutting me off already. Not a good start here. My name is Nick Mellis. I'm a vice president with JF Capital Advisors. I've been with the firm for a little over 3 years, and I have the distinct pleasure of interviewing the CEO and founder, Mr. Jonathan Falik. So Jonathan, if it's okay with you, I'm going to go ahead and jump right in.
Sure.
All right, sounds good. So Jonathan, my first question relates to some of the challenges and the limitations with the data that's being provided. So the first is the STR data. Obviously, in a lot of the major markets, there's a lot of noise. Take it for here in New York, a significant amount of the hotel supply is either completely closed or partially closed. How should hotel owners, asset managers, lenders, et cetera, be thinking about that data? Should they continue to pay attention to it, or should they look at something else instead?
So data is always good to pay attention to. The relevance of the data is sometimes in question, right? So every data point that you have is useful to reflect on. We've had some challenges with the Smith Travel, the STAR data for some time as we look at different hotels in the same markets and across markets. And one of the things that we find is that Smith Travel is great at accumulating the data that's presented to them and spitting it out in certain formats that most of us in the industry are accustomed to. The problem becomes if you show up, or if I show up for a conference, say in Phoenix, Arizona, say I'm going to the lodging conference in Phoenix, Arizona, and I show up not at the conference hotel, but at another hotel, right? They're not going to, and I stay, call it at Marriott or a Hilton. At that Marriott or Hilton, they're not going to be reflecting me as coming to town as part of a group, right? They're going to think I'm either business transient or leisure transient, depending on what information they got when I made the booking and how they reflect it. And in today's day and age, where customers are very addicted to their loyalty programs, to certain boutique and lifestyle hotels, and have figured out with their GPS devices and their phones and with Uber that they could stay further away from a conference hotel and easily get to where they're going and can stay someplace either cheaper or within their loyalty program family. So we find some of the data is misleading. Then we come into this COVID-19 environment, and the way Smith Travel, and they're straightforward about this, the way they are accumulating the data and spitting the data out, if a hotel is closed, and you can look on the Smith Travel website to see their actual procedures, but if a hotel is closed, those rooms are removed from the denominator of the equation. Which makes the occupancy in a sub-market or an overall market appear to be inflated. So it's the actual occupancy based on what they have reported, but they're not including some of the big box closed hotels and even small closed hotels. When you dig deeper into the data, and you can see this, right? New York Smith Travel's reporting roughly 35% or so occupancy currently in New York City, and we think that's inflated by 10 to 12 points. So it's misleading, and that's because some of the big super tanker hotels are shut. Some of the boutique and lifestyle hotels that rely on a lot of people that are coming for food and beverage and bar business and lifestyle are shut down. We've looked to Calibri Labs for their data where you get a much more robust set of statistics, including where the bookings have come from, the cost of the bookings. So that's an interesting data point that we've started looking at with some of our properties and some of the property managers for hotels that we asset manage. But similarly, one of the things that's happening in this COVID-19 environment, there's a fair amount of group business and contract business that people are getting, whether it's first responders, homeless, Department of Homeless Services, FEMA, and others. And in some cases, that's getting reflected as group, and in some cases as contract. So it's very difficult, and it's very difficult to take the data and without understanding the real components underlying that data and understand. I'll give you
Got it.
one more significant example, and this is not specific to Smith Travel. It's relevant to them, to every data provider, and to the way we look at financial statements on a monthly, daily, weekly, quarterly, and annual basis. If you take OTA business, and there are a lot of hotels in the major markets that have a fairly significant amount of OTA business, and especially
Right.
the independents, if you look at the OTA business, they have a number of different models for how the transactions are done. But the primary model, the big two players are Expedia and Booking.com. If you take a hotel room, and I went to the Hilton on Avenue of the Americas today, and booked a room for tonight at $200, and I booked it through Expedia. The actual amount I pay is $200. Expedia is going to take a 15 or 20% booking fee, and the hotel is going to record the net number in their ADR and their room's revenue. So if I pay $200 to Expedia, they're going to pocket $30, and the hotel is going to book a 170 ADR. If I book that same exact room for the same exact day using Booking.com, the hotel is going to reflect $200 an average daily rate, and is going to subsequently get a commission bill for $30 to pay to Booking.com. So if you're looking at the ADR and not the net ADR, net of the booking costs or the customer acquisition costs, you're going to get a wrong number.
Right.
Or it will be the right number, but it will be a misleading number.
Right.
So we're having difficulty with dissecting some of the data, and realistically, whether Smith Travel is telling us, the submarket is at 22% occupancy or 32%, what we look at much more than anything else is total demand. What's the total number of room nights booked? Because that tells you, are there people paying for rooms in that submarket, in that hotel, in the comp set, in the submarket? And we're going to have really skewed comparisons for the next 24 months or so, maybe longer, but I think for at least 24 months when you're looking at Smith Travel, RevPAR penetrations, and all of that is going to be tricky for management companies that have performance tests like that, or asset managers, owners that are trying to make sense of, why was I outperforming last month and I'm underperforming this month? And it might very well be because there's a ton of contract business.
Sure. And then what about on the supply side? So I saw the numbers that came out of CBRE last month, projecting new hotel supply for the entire U.S. of 1.5% in 2020, a decline of 1.1% in 2021, and completely flat in 2022. First of all, do you believe these numbers, and how should hotel investors generally think about hotel development? If a project is not already under construction, what's the likelihood that it's actually going to be completed in this type of an environment?
So when you look through past cycles, you see the same recurring pattern, right? When RevPAR is growing and the hotel industry looks good, you see more and more new development starts. It takes, a solid 2 years to build a limited service hotel. It takes a solid 3+ years to build a full service hotel. You might be in pre-development and planning before that. So while our occupancies and our rates and our RevPARs reset on a daily basis, you can't reset your supply on a daily basis. So as we look at it, new construction financing, new debt financing, and new equity to support new hotel construction is virtually dead right now, and will be extremely challenging and extremely slow for the foreseeable future. Part of that is a function of just uncertainty and the ability to underwrite a market or an asset. Part of it is the ability, if you're an equity investor, to figure out where you're going to get the debt. Part of it is the lenders trying to figure out where will construction costs be and what will the demand look like. And right now, no one knows. No one has a playbook for this environment that we're in. When we went through the last severe down cycle in 2008, 9, 10, 11, occupancies dropped from roughly 66% to 53%. You did not have a period when occupancies dropped from 66% nationally, to single digits. During that period of time in 2009, RevPAR for the industry was down just under 17%. Now, you just mentioned CBRE. You didn't mention the RevPAR stats, but CBRE, Smith Travel, Price Waterhouse are all in the same kind of neighborhood where they think that RevPAR for 2020 will be down roughly 50%. Right? So multiples of what we've seen in the last cycle and in the post 9/11 environment. So what we think will happen is the hotels that are under construction that were already fully financed, all the equity and debt committed, will most likely continue to get built. In most of those, the construction continued, right? You might have had a small blip, but then the construction workers were deemed essential, or someone figured out how to call them essential, right. And things are getting built. Some of them will slow down a little as lenders look and say, hey, we need to rebalance the loan. We need more reserves, or, hey, you were shut down for 2-3 months, and that means there's going to be a bigger interest carry, a bigger real estate tax carry, a bigger property insurance carry. So we need to rebalance. And we, as a lender, thought you were going to stabilize after 24 months. Now we don't have as good a feeling about that. We want more reserves, and that will be back and forth, arguments between borrowers, also between equity JV partners, right? They'll be looking at each other saying, hey, we're going to need more working capital to finish this. But by and large, in just about every hotel construction loan, there's a meaningful completion guarantee, that is backed by net worth and liquidity. And those are negotiated very hard by the lenders. They're relied on very much by the lenders, not so much to go collect, but to basically, have a hammer over the developers and be able to, apply some pressure and some leverage. And as a result of that, we think the things that have started and are underway and fully financed will get built and open. Things that have not broken ground, things that are not fully financed, right, are going back to the drawing board. It's going to be, how do we recut this? How do we bring the cost down? How do we figure out maybe a different brand, maybe smaller room sizes? Why are we going to go ahead with restaurants and banquet facilities the way they are if we don't know what the post-COVID operating environment will look like?
Sure.
So that, I think that answers the second half of your question. You asked me, how do I feel and how do I think? Do I believe the numbers on supply growth? So even before getting into those numbers, we got to the point where several years ago there was minimal supply growth of new hotel rooms. Then it started to grow, and it grew, and it got to 1%, versus a long-term historical average of about 2% annualized supply growth. It grew, it got to 2%. And we still, as an industry, had a problem raising average daily rates, especially in some of the major markets like New York City, where new supply came, ADRs went nowhere, but occupancy remained at all-time highs, sky high. So one of the factors that has contributed to that is it's not just new supply of independent hotels and Hiltons and Marriotts and Hyatts and Wyndhams and the like. You also have a meaningful amount of new supply that's come into the major markets and the resort markets via Airbnb, VRBO, other shared accommodation providers, where CBRE reported, I think about a year ago, maybe a little less than a year ago, that if you look at the supply growth, including the shared accommodations, the annual supply growth is over 4% instead of 2%, which would be really kind of devastating. So when you look at the CBRE and the Smith Travel statistics, they are generally not assuming, excuse me, they are generally not assuming that hotels that are closed right now will be permanently closed, or some hotels that are open will permanently close and convert to other use or be totally repurposed. I happen to believe the exact opposite. I think there are a whole lot of analyses that are going on right now, which is a detailed analysis into what is the highest and best use of this large piece of real estate or well-located piece of real estate in a major urban market, maybe in a suburban market or resort market, but in a major urban market, especially with, especially those that have heavy and onerous union labor contracts. How do you reopen? What does that cost? What sort of profitability can you make going forward? Versus if you could figure out how to change the zoning, the permitting, the permitted uses, and convert to whether it's multifamily apartments, senior housing, assisted living, various things where the operating variability is substantially lower, the NOI margins are substantially higher. So if you converted a hotel and you have to go through several different processes, and I would recommend getting counsel involved pretty early on that. But if you went through that process, and you could convert a hotel in the middle of Manhattan to an apartment building, then all of a sudden you're going to be at 90+% occupancy. So you're not losing occupancy, and you're going to run an NOI margin in the high 50s or roughly around 60%. And you're not going to have to worry about your occupancy fluctuating on a day-to-day basis and your rents fluctuating on a day-to-day basis, right? You'll have rollover, you will have some issues, but it's a much easier, much less risky business to manage. So we think there's going to be a lot of drop off and drop out, with some hotels just either never reopening or taking a big portion of their inventory and no longer operating it as a traditional hotel.
Got it. Thank you. So we're sitting here, we're already at the end of July. I think we all know and understand that we're in a completely unprecedented operating situation. You cited that in the CBRE stats. I think that that's clear. All of the industry prognosticators out there, they agree that there's going to be a significant RevPAR decline this year, and that it's going to take somewhere between 2 to 3 years minimum for the industry to come back. But what are some of the unintended consequences of COVID that people aren't necessarily talking about? Where could there be potential litigation, potential disputes, and who would those key partners and key groups be? So the first one that I'd love for you to talk about is brands and owners.
So the unintended consequences are huge because we're in unprecedented situation. You're seeing disputes, or we're seeing disputes in a lot of areas, and it's very difficult for well-researched, intelligent, experienced professionals to make decisions, right? There's just very little clarity and very little data. So you asked about brands. The major brands have actually been quite helpful in the short term. They have agreed to allow owners to use FF&E reserves. They've allowed owners where franchise, they've allowed owners to go to shut down hotels or go to limited staffing. They've suspended a lot of F&B service requirements. They've suspended a lot of other brand standards and ongoing requirements. They've cut down some of their brand related fees, and partly because they understand what owners are going through, and partly because they're dealing with their own P&L and their own balance sheet at the same time, and have furloughed a lot of employees, not just nationally, but internationally. So what we saw in 2000 and Q4 2008 and 2009 and 10, the major brands were very accommodating as well. They understood owners aren't sitting flush with cash, and they relaxed PIP requirements and certain brand standards. Though once you got to 2013, 2014, and RevPAR was ticking up, even though EBITDA was not recovered to where it was and margins weren't quite there yet, you were seeing an uptick and an uptrend. The brands were then again looking at quality assurance inspection reports very rigidly. They were looking and saying, hey, that PIP that you were supposed to do in 2010, that just got pushed and pushed, like it's time to start figuring out how to do that. Similarly, on the managed side for brand managed assets, they're dealing, they're going to owners and requesting a lot of working capital in order to make payroll, in order to deal with the carry costs. And in a lot of cases, the owners are not used to getting such massive amounts of requests for capital, especially when either the hotels are shut down or working on limited occupancy. So I think you will see a significant amount of both threatened and actual litigation from franchisees and from hotel owners against the brand franchisors and the brand managers. In some cases, it will be entirely legitimate. In some cases, it will be pressure points. Pressure points or part of negotiating tactics and strategies.
Got it.
So that's going to play out, but there will be a significant increase. There will be some people that look at it and say, I just can't run this box as a full service 4.5-star upper upscale hotel anymore. It's going to have to tone down, and I'm not going to satisfy these brand standards. And in some cases, the brands will say, too bad, you signed up for a 20-year agreement.
Right.
In some cases, they'll say, okay, we'll work with you. We have other brand options that come with a different service level and a different price point. So,
Right.
I don't want anyone to have a takeaway that the brands are doing anything bad or inappropriate. They're doing what they need to do and should do. And franchisees and owners are going to continue to do what they need to do and should do. And everyone is operating in an environment with very limited certainty.
Got it. Do you think you'll see some disputes with the third-party managers as well?
You'll see disputes with third party, so you mean independent
Yes.
independent managers. You'll see disputes there, but generally speaking, the independent management contracts are shorter and easier to exit. So there might be disputes over, is it 2 years of liquidated damages or 1 year, or if there was key money involved or some sliver equity. How do you do that? How do you deal with it? I think the disputes with the independent managers will be very similar to the ones with the branded managers. Why do we need this amount of working capital? Why can't you cut this? Why can't you cut this? And again, in some cases, it will be totally legitimate, and in some cases, it will be owners who are just feeling a lot of pressure to try and cut their losses. And as a practical matter, if you're an operator, you cannot operate with half of a general manager. You can't pay half your property taxes or half your property casualty insurance. We have a high fixed cost burden. And in times like this, that really pops and makes it obvious, how high a fixed cost burden the hotel industry has.
Got it. Thank you.
What
about between
go ahead.
lenders and borrowers?
Yes. Yes. There will be a significant amount of increased litigation between lenders and borrowers. And when I say lenders, I loop into that, it's balance sheet lenders, it's commercial banks, it's debt funds, it's CMBS trusts. So then you're dealing with, special servicers and master servicers on behalf of the trust. I'll do a little plug right now on July 30th. I'm doing a webinar similar to this where I'll be interviewed by Larry Epley from Shepherd Mullen, talking about what's next and what's going on with lenders, master servicers, and special servicers. So we'll get into that in more detail on July 30th. If anyone wants to get information on registration, just email me afterwards, and I'll get you the link to the registration. But we're seeing it, right? The special servicer universe 4 months ago had virtually no hotels in special servicing. Today they have almost 1,500, with another almost 1,000 that are not on special servicing, but are non-current, meaning they haven't paid their debt service within the last 30 days, some of them not for 60 days. So that's almost like who's on bat or who's on deck to go into the special servicing world. And that's just CMBS. So, no one who put debt on their properties had a contingency plan for going to, a complete halt and a complete shutdown in domestic and international travel, and what the related consequences are, and at the same time, a complete shutdown in their local patronage of their bars, their restaurants, their spas, their other facilities. So no one has a plan for this. the lenders are dealing with them and doing a lot of short-term forbearance requests. In some cases, they're taking very aggressive positions. Though in most cases, we found lenders are taking very reasonable positions, but they don't move at the same speed and frequency as the borrowers.
Sure. And what about at the partnership level?
We're we're involved in 6 or 7 right now partnership disputes where there are issues over what the long-term strategy is, what the funding strategies are, and I suspect we'll get involved in many more as especially as we come to the end of some of the forbearance periods, the lender forbearance periods, as we come to what is supposed to be the RFP season with corporate negotiated rates, and no one has any real clue as to what corporate users of hotel rooms are going to need and how they're going to negotiate. And as we come into the period where we're examining 2021 budgets, and there's so little clarity. I think once you see that, and once people start to see, okay, this is not a V-shaped recovery for the hospitality industry, maybe for the economy, probably not, but certainly not for the hospitality industry. How much more are they going to have to fund? How capable are various partners of funding? And where should they be spending their time? So we're seeing a lot of disputes, which is not atypical when you get into adverse financial times, and negative, operating performance or very, very bad operating performance. So we'll see how that plays out. But I think you're going to see a lot more litigation and a lot more arbitration. Many of the JV agreements call for arbitration rather than litigation, which in some cases can move a lot faster. Not all, but some cases can move a lot faster, and in many cases are a little bit cheaper than a full-blown litigation.
Sure, got it. Thank you. Okay, you touched on this a little bit earlier, but the brands have been extremely cooperative when it comes to brand standards, quality assurance, really only focusing on fire and life safety, additional sanitation and cleanliness. How long do you think this continues? Does this extend into 2021? 2022?
Yeah, the brands will cooperate and help and whatnot as long as you're reasonable, right? They're not going to compromise on fire life safety issues. I think they will start to get more rigorous than they have been on cleaning and sanitization standards and protocol, because that's so critical for, number one, the reputation, and number two, getting customers actually comfortable enough to come and travel and stay in hotels. So I think they'll be very insistent there. But I think you have a few years. I think you have a few years at a minimum before the brands as a generalization are getting very aggressive on refilling FF&E reserves and spending dollars and quality assurance inspections. Like, it's very difficult, same thing on guest satisfaction scores. It's very difficult to hold a hotel accountable for poor guest reviews, when the guest says, well, I come to this hotel once a year and I do this in the pool and I like having my hamburger, at the beach bar, and now the beach bar is closed and the pool is allowing, 8 people at a time, and the customer leaves a terrible review. So
got it.
There's a lot there that's going to cut both ways, but I think you're going to see the brands being quite cooperative, within reason, until you see a real upward movement in RevPAR, and in operating profitability, and within that is the reevaluation of many of the legacy brand standards. I don't know if you want to talk about it later or now, but things like housekeeping, on a regular basis. You want to talk about that later or now?
We could talk about that later.
Okay, I don't want to mess up your flow.
Questions that I want to get into. Thank you. And then just the last piece of that, how should owners be thinking about upcoming PIPs within the next, 1 to 2 years? Obviously, cash flow is very, very limited, but for those owners and assets that are well capitalized, is the time now, or should they be waiting?
So it's interesting. Like, we have a few hotels that we asset manage that, we're moving well along, getting PIPs done, and we huddled with ownership, we huddled with our operator and said, should we, pull the plug on everything, or do we just go ahead and get it done and take advantage of the time when we're not really displacing much in terms of rooms revenue or food and beverage revenue, now is the perfect time to go do the work. Now, in that case, all of the FF&E had already been ordered. Everything, everything was warehoused, or almost everything was warehoused. So it was a much easier decision to push forward. Someone who was, in the design phase and getting ready to do purchasing for a PIP, I think the best thing for them, and it's situation specific, but the best thing to do is going to step back and reevaluate a little and say, what's most important? Because some of the things they're going to do and buy and implement may not even be a brand standard in a year or 2 years, right? So there will be some changes in the number of things that are in a guest room, the number of things you can touch and feel and poke, and that's a direct outcome of the COVID sanitization protocols we're seeing and people's mindset, as well as what equipment you're putting in and using and utilizing in public spaces, right, and in back of house spaces. So, if you have a PIP sort of that you're in the early stages on getting ready to do, I would hit the halt button and take a look at it, and see what is really necessary. Now, to do that, you still have a brand requirement to do it. So you'll have to get your brand to sign off on holding off or extending deadlines. And then to the extent you have debt on the property, there's an almost certainty that you would have to go get approval from your lender to hold off on doing that work as well. And there might be dollars that are escrowed for it. There might not be, but in general, if the lender knew that there was going to be a PIP, within the first, second, third, fourth, whatever year of their loan, they factored that into their underwriting, and they wanted to know that the dollars were spent to update their collateral and refresh their collateral. And if it's not done, they may have a problem. And most lenders that we're talking to about this very issue are very understanding, and they're saying, you don't have to go ahead and do this right now. Work with the brand. We'll be accommodating, but will they be as accommodating in 3 years? Mm-hmm. Some yes, some no. So that's a very important one to watch. And in some cases, we expect that the availability of labor, for general contractors and subcontractors will become more available and cheaper. Mm-hmm. In terms of getting work done and scheduled, where some people, and that of course depends on what area of the country you're in, what municipality, what city, and what state. But right. If all of a sudden a lot of larger construction projects slow down or come grinding to a halt or are held off, well, then all of a sudden the subcontractors are more readily available. We're also going to have to get into, many of the PIPs that we've done in the past. We've sourced a lot of the product from China, and and over the last year to 2 years, given the tariff situation and others, we've continued to source stuff from China, but have pushed a lot of things away from China to other countries and even some domestic in the United States to reduce our reliance on what's coming from a factory in China, what the tariff situation is and looks like.
Got it. Thank you. Next question, I want to go to the lending side of the business. So as you said, we're beginning to get to the end of the initial 90-day kind of a forbearance period on many hotel loans since the onset of COVID. For most hotel owners, this initial forbearance was relatively easy to attain. They didn't have to necessarily pay down a significant amount of debt, if any, produce an updated business plan. So with these coming due, kind of how do you anticipate the majority of lenders will treat them? Do you think that the majority will need to pay down debt, or what will the outcome be?
So the answer is it depends, right? And everyone knows that, right? So as you said, the first forbearance request was generally fairly straightforward, fairly easy to get, assuming you didn't throw in some ridiculous asks, right? So when the ask starting at the end of March or in April, or even at the end of April or beginning of May, was we need 90 days of forbearance. So basically, just accrue the interest for that 90 days. Let us use FF&E reserves for operating expenses or debt service, assuming our brand will relax our, any debt covenant restrictions or any cash management provisions that would have kicked in just now, just because of this. and we'll come back to you in 90 days. We also, asked, and most people asked, we need the ability, pre-approval, to shut down the hotel or go to limited staffing, which in a lot of cases you have a covenant in your loan documents that basically provide that you must continuously operate the hotel, or you must operate it in a certain way.
Mm-hmm.
And we also asked for the ability to take the PPP or other similar federally enhanced or credit enhanced loans. And that was a pretty straightforward ask. Some people, all of a sudden said, and I want the ability to prepay the loan at any time with no penalty or fee. And, most lenders looked at the borrowers who asked for that and said, okay, try again, like you can't sneak that in. So, and the 90 days, there was nothing magical about 90 days. Some borrowers got 180 days. Some public companies got longer periods of time and more concessions. To a large extent, what you were asking for and what you could get depends on, did you start off on a pre-COVID basis 70% leveraged or 45 to 50% leveraged? If you start at 70%, the lender's going to be a lot more focused on what's happening. If you started at 45 to 50%, then on any reasonable valuation, even a liquidation value, right, the lender is still in the money on their loan. They don't have an impaired loan. So now we're coming up on the expiration of the first set of 90-day forbearances, and the 90 days had nothing magical about it. It was really, hey, this is, we're shutting down. We don't know what's going to happen right now. Give us a few months to sort it out and see. We'll get the worst of this pandemic behind us. And we'll have some clarity on what the rest of the year is going to look like. We now know no one has any clarity on what the rest of the year is going to look like except awful. So now people are going for the second set of forbearance requests. And to the extent they were a bad borrower, meaning on a pre-COVID basis, they were not submitting their financials timely, they were missing payments, they were, arguing with the lender over various things, the lenders, whether they're balance sheet lenders or servicers, will get more aggressive, will be a little bit more difficult, may require, for concessions, may require some counter concessions. For the majority of borrowers who are good borrowers, they'll get another 60 or 90 days, in a lot of cases another 90 days, because the lenders don't have any more clarity than the borrowers. They may ask for, confirmation of certain things. They may ask for updates of representations and warranties and maintenance of certain covenants, but for the most part, they're going to get another 90 days, right? And the borrower may have to give a little bit. Once you come to the end of the second 90-day period and you come to late in this year, the vast majority of lenders are going to say, hey, no one contemplated this. You're the equity, right? You're the one who's supposed to be at risk. I'm the lender. The best thing I get as a lender is the best thing I ever get is a repayment of my principal and payment of interest expense on a timely basis. That's the best thing that I get. So if you want me to take short-term concessions, but you're going to hold this asset long-term, there's a misalignment of interest. So the lenders then, at the end of the second set of forbearances, and this is a generalization, right? Not everyone's deal is the same, but we expect the lenders are going to say, we're still willing to work with you because we don't see, an immediate recovery. However, now it's time for you to give some concessions as well. Now it's time for you to, if you want us to extend the maturity, you want us to waive a bunch of requirements, pay us down $5 million. Fund some extra interest reserves, fund some operating expense reserves, fund extra reserves for the ground rent payment for the next 18 months. Oh, I have a big problem. So for the 200 plus that are dialed in right now, and expect another 100 or so will listen to the recording. I agreed before this webinar that anytime I said or that I would write a $100 check to a charity. So I don't know how many times I did it. I know I just did one. I'm sure some of our team at headquarters is going to mark this down, but I'm going to try
like a job for the intern
not
Ryan.
to say and for me, it's worse than or whatever. But I'm going to try not to do that. So Well, if you say it, I don't have to write the
There you
check.
go.
If you
There you
say it, I
go.
don't have to write the check, Nick. But if I say it, it's $100 check each time, and I'm sure some people will be diligently studying the replay to make sure that the appropriate charities get the appropriate monies. So what I expect will happen is borrowers will have to give some, and many of the lenders will work with borrowers who are willing to fund some more dollars, provide some more guarantees, do some things. Where the borrowers, in another 3 months from now, or whenever they're ready with the end of the second forbearance, when they come and say, I'm not putting another dollar into this, I don't see the value, or I don't this, I'll give you the keys, I don't care, foreclose on me, I'll file a bankruptcy, whatever that response is. If it's not, hey, I'm going to support this asset, I stand behind it, I will support it, then the lenders will start getting more aggressive. Then you'll see foreclosure actions filed, you'll see default letters sent, you'll see some of the loans will get sold to more opportunistic investors that are more than happy to foreclose or do a significant restructuring. So I think you're going to start to see that once we come towards the end of the summer and into kind of the September October timeframe.
Mhm.
September October timeframe, and that will be accompanied by 2021 budgets. So I think it's gonna, right now there's not been a lot of aggressive borrower lender wrangling because lenders, for the most part, don't want to take back the keys to a closed down hotel when the other hotels in the comp set are closed down, and they don't want to have to step in and provide replacement guarantees. They don't want to have to step in and provide replacement guarantees to brands, to senior lenders, et cetera.
Got it. Thank you. The next question, I know that this is near and dear to your heart, Jonathan. So I want to talk about union labor. So back in March, here in New York City, Local 6 Hotel Union reached an initial agreement with more than 150 hotels, which significantly reduced the number of rooms that housekeepers are required to clean, and additional positions were also created with the idea of cleaning public spaces. In June, the agreement was extended to include even further sanitary standards, including mandatory daily room cleanings, even if a hotel guest doesn't necessarily want a housekeeper to come into their room. So Jonathan, would love to get your feelings on the June agreement, and also what do you think happens in August when the
So,
agreement ends?
so there are different there are different issues all over the country. Normally, a lot of the hotel labor unions come across very aggressive and then are ultimately pretty reasonable in terms of how the bargaining works. In New York, they have gotten historically and currently the best hotel union contract in the country. They're not shy about bragging about that, and they've done it. They've been very effective and in representing the employees. If the original wish list were to come into being and the union put forth in New York a roughly 14-page wish list of additional policies, procedures, protocols, payments, benefits for employees, I think that would essentially bankrupt every hotel out there. And they differ from the brand standards and kind of the industry standards that Marriott, Hyatt, Hilton, the major management companies like Aimbridge, Pyramid, Davidson are putting out. So problematic, and one of the big issues in the New York City agreement is severance that they generally think would kick in or get triggered after 6 months. The Hotel Association of New York has a negotiating committee that's been negotiating, or they have a series of committees that have been negotiating with the local hotel union. And I think the local hotel union has backed off a little bit, understanding that, implementing all of the procedures that they would like, including, severance for numerous employees, is not financially feasible, and hotel owners are not sitting on piles of cash, waiting to pay this, and that would cause a lot of upheaval and a lot of legal challenges and others. So it looks like there's shorter term extensions of the existing agreements. The unions will be a little bit more reasonable. You mentioned one of the things that they want to have daily housekeeping. They want to have rooms cleaned on a daily basis, which is in direct contradiction to what we're seeing as operating practice and protocol for basically every major hotel management company out there. So more to come there, but if the union in New York pushes too hard, they'll end up with a whole bunch of hotels that just never reopen, or they reopen and shut down, or they reopen and never reopen their food and beverage operations, try to streamline other operations, and they'll end up with less members and less jobs and less hours and benefits for the union members.
You touched on my next two questions. So do you think that most New York City union hotels will get through the pandemic? And what happens to union membership going forward?
It's a big, it depends, right? I don't see how some of the big boxes make it all the way through, right? Their margins had been, deteriorating significantly on a pre-COVID basis. Now add a number of years of carry cost into the mix, and no clarity on what happens in the future, right? When is group going to come back? When is business transient going to come back? What about F&B? When can you actually open restaurants and open and operate restaurants and bars, and what will it look like? So I think that a lot of the larger boxes are either going to work very hard to convert to other use, or partially convert to other use, and that will be the subject of a lot of dispute and litigation and fights and back and forth with city councils and government agencies and the unions, and it'll be messy. But in a lot of cases, having a big box hotel in a market where you just can't make an operating profit, your EBITDA margin is minuscule, isn't going to work.
Right. So what do you think needs to happen for the unions to be a little bit more reasonable in their negotiations? Is it a major drop off in membership?
So Nick, the unions are the union leadership, in New York especially, is very reasonable, right? They're looking at it, and their job is to basically, protect their members, get the best, financial deal for their members, the best, benefits deal for their members, the best protections, for ongoing job security, and they're doing a great job. They've always done an impeccable job, right? If I was a union member, I'd be like, lifting them on my shoulders every day, saying thanks for getting me the best contract, in the history of the hotel industry. So they're doing what they do. The issue right now is no one has a budget that makes sense, right? No one knows. And to make it actually work, the unions are going to have to, and not just in New York, everywhere, are going to have to sit with the major management companies, with independents, with owners, and say, you know what, we know the only way you're going to survive in the future in the hotel industry is by embracing technology, by reducing your operating costs. We still want to protect our employees. So the hotel owners are going to say, hey, we need robots to do certain things in the kitchen, or we need robots to clean rooms. That's less housekeepers. But that's the only way. That's the only way that hotels are going to make it in the future. In an environment with high labor costs, not enough demand, not enough ADR. So you're going to see a lot of push for more technology. You're going to see a phase out of certain things. We both mentioned housekeeping before. Like, I don't have daily housekeeping at home. You don't have daily housekeeping at home. You use a towel. I use a towel more than once before I throw it on the floor and expect it to be laundered. Maybe I'm in the minority. I don't think so, based on the people I talk to. So, we've been almost forcing daily housekeeping in the hotel industry on every one of our customers, and we've had to jack up the average daily rates that we charge, to compensate for that, which to me is ludicrous, right? Why not? Why not? And you're seeing this right now. Right now, in many hotels, rooms are getting cleaned either only on a checkout, or after every third or fourth day, or on customer request. Right. So if you can end up all of a sudden, cutting half of your housekeeping labor because you're not cleaning the rooms as much, and you're doing a more thorough clean on a checkout, but you could cut your labor very substantially. That works. Same thing in a kitchen, right? Or with a front desk. We all I believe just about everyone dialed in here, goes to an airport, right, and barely talks to a person, right? They check in online, they have a boarding pass online. If not, they go to a kiosk. They go to a kiosk, right? And if there's a big issue, they go wait on the line. We're seeing an acceleration of that. We're going to see more and more of the digital check-in. Check in advance, pick your room. You need concierge service or front desk or housekeeping services. It's going to be available either on your brand app or by text message when you get to the hotel. So we need to operate the business with a lot less labor, and the hotel unions won't like that, but that's the only way for the industry to come out the other side, to be profitable and to maintain the jobs for the remaining employees.
Got it. I also want to touch on the public hotel markets, because I know that you spend a lot of your time there as well, Jonathan. So what's going on in the public hotel markets currently? Where are valuations now? And are they at all instructive to private hotel investors?
So they get a lot of attention, and things are measurable. So private investors are always excited to see, oh, well, this public REIT did this or is trading at this EBITDA multiple or this cap rate. To give you some perspective, in December of 2019, the hotel REITs were trading at a roughly 7.5% implied cap rate. That's the NOI divided by the enterprise value, the public enterprise value of the public hotel REITs. Today, it's at about 10.5%. So we've seen a 300 basis point widening in the implied cap rates, which is huge. The public hotel REITs and the C Corps tend to be much lower levered, so they have a lot less debt on a relative basis than a lot of private owners and investors. They tend to be larger with institutional management, with lender relationships, with revolving credit facilities, and with the ability to issue unsecured debt, secured debt, mortgage debt, to issue equity, preferred equity. So they have access to a lot more liquidity than private investors and companies normally have. You saw the public hotel stocks get decimated when this started in March, and then they've rebounded quite a bit, but they're still way down from 2019 levels. And we're about to get into the second quarter earnings season, where you're going to see the REITs and the C Corps start getting on earnings calls and doing their press releases saying we really have very little clarity and very little outlook, and we don't have good guidance for you, and our cash burn rate is this, and our liquidity is this. And I've been doing this for 25 years, a little more than 25 years. I don't recall any time where I've heard hotel REITs or hotel C Corp senior management get on the phone and talk about cash burn rates, and how many of their hotels are closed and how many employees are furloughed.
Mm-hmm.
So we're in a totally different paradigm. And I think when public investors see and appreciate that, Q2 was bad and no one has any real guidance that's meaningful for Q3 or Q4 or for next year, and it's still going to look quite bad, I think you may very well see stock prices, public equity prices drop off again. So, are public markets instructive for the private world? Marginally. It's good data points to have, but the securities are readily tradable versus private real estate, where you can't just decide to sell 10% of your hotel
Right.
to someone overnight and buy it back at a different price the next day. So, there's a lot going on in the public markets. And a big portion of what I believe the return in stock prices and why they're not trading substantially lower than they are today is the buy side investors, the large institutional funds, the mutual funds, even hedge funds, are looking at the public REITs saying, well, you have liquidity, you have access to capital markets, you have sophisticated management. We think most of you will be the survivors, right? So even though your EBITDA may get walloped right now, you're going to be in really good position to buy assets cheap, to buy
Hmm.
good quality assets really cheap when you couldn't figure out how to do that in 2019 or 2018. We think you're going to be the survivors, and
Got it.
other hotels are going to, others are going to shut down their hotels. They're going to struggle. They're going to down brand. Like you're in better position to take advantage of the upside.
Hmm.
And if and when investors don't believe that's the case, you're going to see hotel stock prices plummet.
Got it. Thank you. So I have one last question, John. I think we have a little under 4 or 5 minutes now. What happens to the independent hotel post-COVID? In times of economic distress, the way that a multitude of hotel investors and lenders think about it is that if I have a major brand, a Hilton, a Marriott name, my hotel's a little bit safer than if it's independent.
Sure.
What do independent hotels need to do to weather the storm? And do you anticipate that a lot of them will go with a soft brand? So be it an Autograph, a Curio, a Tapestry, et cetera.
So I think the answer totally depends on who the manager is, right? An experienced, established management company managing an independent hotel that understands the various booking channels, understands how to drive revenue, and has historically done so without a brand is going to be much better suited to come through this environment and fare reasonably well versus versus someone who just sort of relied on where the market occupancy was, doesn't have a sophisticated independent management company. When you look at the last down cycle, the soft brands as we think of them today didn't really exist, right? So Curio and Tapestry, Hilton soft brands didn't exist. Autograph was in its infancy. There were only a handful. Of autographs at that point in time. They didn't have a tribute. Similarly with the other major companies, there was no Unbound by Hyatt. There was no Trademark by Wyndham. And a lot of hotel owners and operators would have benefited tremendously from latching onto a brand and the reservation system and the loyalty programs as they come through the upside. I think one of the biggest beneficiaries of this, of this COVID-19 crisis will be the soft brands. I think you'll see more conversions to an Autograph by Marriott or a Curio by Hilton or a Tapestry by Hilton than you will conversions of independents to hard brands. And for a few reasons. Number one, it's quicker and easier to do. You don't have to replace 100% of FF&E. You can still incorporate whatever kind of signage, branding, imaging you had, while joining one of the soft brand families. So it's a lot easier to do. It's a lot quicker to do. It allows you to maintain some level of individuality. But by and large, I think everything is going to come down to, management, who's managing the property, and how well do they know how to use the various booking channels.
Got it.
Nick, do you want to run through 2 or 3 of the questions that we've got like 20
Sure.
questions here? Do you want to run through 2 or 3 of them quickly?
Yes. So let me find the one I was looking at before.
Go through each one. Do almost like rapid fire. We'll get them all done within 3 minutes.
Okay. So would you attend a large industry business conference right now?
No.
All right. As an industry, we're facing significant average rate reductions for years to come. In order to compensate, operators must innovate dramatically to improve GOP. What are some of the best ideas to achieve this in a meaningful and sustainable way?
We talked about this already. Remove labor where you don't need it. Get rid of housekeeping every day. Use robot or other technology in the kitchens and for service. Focus on what guests really want, like, and need, rather than what we've historically given them.
Do you expect the construction and FF&E pricing to decrease with demand coming off of peak levels?
Yes, to some extent, but it's sub-market specific. In most markets, you'll be able to find subcontractors and GCs hungry for work, and FF&E pricing should come down. What we're seeing at a high level is, and it's still very early on this, what we're seeing at a high level is about 15% or so drop in construction and FF&E costs and pricing.
Got it. Do you expect conversions of hotel product to face challenges in union-dominated markets, such as here as in New York?
Yes, massive challenges, and a lot of that will end up in various forms of litigation, dispute, etc. But at the end of the day, the analysis is going to be, how is an empty, shutdown hotel going to be, and what's that going to generate for the city or municipality in terms of jobs, in terms of property taxes, et cetera.
Got it. And with that, do you anticipate hotel owners to appeal property taxes? I know we're already working on that.
I think it's almost criminal. Everyone may have their own reason, but it's almost criminal to not appeal property taxes. The issue is this, and we've been seeing a lot of pro formas lately that show meaningfully reduced property taxes over the next few years. And, the reality is, if it was only hospitality that was in a world of hurt, that might be the case. I think,
Mm-hmm.
most owners are going to be successful in reducing their assessed value, but the millage rates, right, the property tax rates municipalities charge are going to go up.
Right.
Because they have, almost every municipality in the
Significant
country has
deficits.
significant budget deficits.
Mm-hmm.
They're going to have to figure out how to fund, and government is not good at figuring out how to rationalize its own P&L. So their answer is more revenue. More revenue to a government means more tax to the properties.
Got it. Do you predict any decline in brand fees or management company fees moving forward?
Not meaningfully. Some things will be reduced down, and some will be waived on a more temporary basis. But longer term, not so much, right? I think there will be some waivers and some relief in a short term. Long term, I would not count on it.
Got it. Do you think that brand standards will change pending the issues that have come about with COVID? So do you feel that the hotel companies will begin to monitor actual application of cleaning and different sanitization processes rather than some of the other points of focus that they had pre-COVID?
They will. The brands and management, large managers will get more and more focused. Over time. In the interim, they're dealing with so many issues, so many headaches. They're dealing with their own company situations with owners. They'll send warning letters if they understand that people are not following sanitization or cleaning standards. But doing a QA right now, I don't know how a brand sends inspectors out, even if they wanted to do a quality inspection report, if that inspector then is going to return home and has to quarantine for 14 days, depending on which city or state they're in. So this is going to evolve meaningfully. Brand standards will change a lot. Some of that will come from owners, screaming bloody murder. And some of that will come from just brands, becoming more thoughtful as they learn and see more.
Got it. What are you hearing about the expectations of the brands to open a closed hotel? I'm hearing that it could involve basically a full soft good renovation, so approximately 15 to 25,000 a key. What are your thoughts?
Totally depends. Totally depends on where the hotel is, what it is, right? If it's a big fee generator for the brands, they're going to say just get it open. Let's do the, let's check the water. Let's check the systems. Let's do a big thorough clean. Let's make sure we're good. For something that the brand sort of wanted out of the system, with a bad owner, a bad franchisee, a difficult franchisee, they may play hardball.
Right.
But generally speaking, tough to sort out.
Got it. Last question. If the hotel is not part of the 150 hotels that previously signed the May Local 6 agreement, do they have to adhere to it?
Paul J. Crouppen, the head of the labor practice at Baker Hostetler, because there will be situation-specific issues. Call him, tell him I sent you over, because he lives this and breathes it, and he's got a team of partners who we work with on a variety of issues, both union and non-union labor issues. But call Jay Crouppen at Baker Hostetler. And Jay, you now owe me a bottle of scotch.
Got it. All right. So I think that that's it for us. We're about 5 minutes over now. So I want to thank everybody for their time. Mr. Jonathan Falik as well. And we'll see about a JF Capital Unplugged 3.
Thanks, Nick. And as I said before, we will circulate the link for the recording shortly after this call. Thank you for being with us today. We appreciate it. If you have any questions about what we've talked about, reach out to either Nick or myself individually, and we'll be happy to spend the time with you.
Thank you.